All right. In today's episode, we are talking to one of my favorite, I would say, Twitter follows and a guy during our last interview that actually really helped me a lot in my own investments, helped me make more money, and also just helped me really understand it better. And we're talking to Ferg, aka Trader Ferg, on Twitter, and one of the first people I started following for uranium and energy stocks back in about March, which was probably pretty close to when you really even started your Twitter account. And so excited to drop in. We're going to be discussing uranium, commodities. We're going to be discussing, more importantly, philosophies and strategies he's using to handle the volatility of the market right now, which I think is going to be a very valuable episode no matter what you're invested in. Last but not least, just want to give a shout out to our channel sponsor, which is Vizsla Silver. So thank you, Vizsla Silver, for being the sponsor to our channel. Make sure you hit the like button on the right side, the left side, send this out to more people. And nice to see you.
Good to see you too, Jake. Thanks for having me back.
Okay, so let me ask you, the last time that we talked, one of the things, I don't know if you recall, but I did not have proper allocations on positions. Like you were talking about 1 to 5%. I didn't have that. And so it caused me, during things were going good during commodities, so it didn't hurt me that much, but during downtimes or corrections, it would make me just feel less stable. And doing that really drastically improved my performance over, I forget when the last time we discussed, but as you've been on Twitter more, professional investor, professional trader, but now you're getting so many messages and comments and people having this problem and that problem. What would you say are the biggest problems or mistakes people make as they're investing? Specifically, let's talk about maybe, investments in commodities, whether it's uranium or silver or anything in between, these cyclical things.
Probably number one is just trading on Fomo. It's essentially all we see is people love to chase what's working. If you look across most of Twitter and the spectrum, it's just people chasing what's working. Even uranium's kind of an example of that. Is go back 6 months and almost no one wanted to hear about it. As soon as it starts working, everyone can't pile on enough, and it's fine with like uranium, like when you're at the start of a long bull market, but it's pretty disastrous if you're piling onto something because it's worked, like Bitcoin or Tesla at these levels. Like, regardless of what Bitcoin does, you've just got to know that like the asymmetry is largely gone from it. And this is where probably smart money is sensing that everyone's on one side of the boat and could tip over. So they're slowly scaling out. So you're providing liquidity to them to get out. And that's not where you want to be in the market. You want to be in places where hasn't even got a sort of the start of FOMO, like fear of missing out. Like, it's still very much at the stage where just a few people are sort of looking at the macro and thinking, this has got legs, this is going to start moving. And that's where I like to be. That's why I always talk about hated sectors, hated stocks. Like at the moment, I still love and I'm still chipping away in the oil service sector and offshore oil. It actually tells you a lot of info when you look at the market. You have big down days across the market, and I've just got like a MacBook, and when you flip the side, the stock like stock indicators, and then you got a whole lot of red and then a few greens, and it's just the few that always buck the trend. Essentially, a few of these oil stocks, they don't even care about the broad market. They're still creeping up 1% or 2%, while everything else is selling off 5%, and that really tells you that they're in strong hands. Like, they're only held by probably a few people, and they've literally pretty much bottomed out. Like, their sentiment couldn't get much more negative. They're not going to get sold off much more, and that's where you really want to be now. You want to be building positions in that, or if you're just uncomfortable with it, then keep raising cash levels. But it's also not this. It's also quite destructive, the idea that you can time the market and go 100% to cash and wait for some some big crash, like to use like uranium, for example, like if I cash out my whole portfolio on the expectation of volatility and maybe I can buy the whole thing back cheaper, you really run the risk of like right tail risk as well as there's right tail risk as well as left tail risk. Right tail risk is the market just completely runs away on you. And that's the idea that with a small liquid sector could run away on you and the crash might not even bring it back to where it is now. And so that's quite a risk as well. So it's trying to just balance all these to make sure you have the best outcome overall. And that's where sort of, shading the hated sectors, having cash to use the opportunities is kind of my take on it.
So there's a lot of talk where people are, the 10-year treasuries rising and people are saying, it's going to bring down the whole market. And it seems like this whole rally since March, it's been a very weird because some people say we're, headed to hyperinflation and other people say we're going to be living in a cave in 6 months and, it's going to be a deflationary situation. So how do you manage all of those types of possibilities philosophically, mentally, and, financially from an investment perspective? And what are your expectations?
Well, number one is know what you own. So if you know what you own, the long-term outlook of it, the margin of safety, has it got enough cash to continue operations if things get pretty negative? That allows you to ride through volatility. Like if you don't get too tied to your account balance, seeing it fluctuate, I really don't care what happens with my portfolio in the next few months. If there's a big crash in the markets, it's similar to what happened in March last year, I guess. I think at one point I drew my account down roughly 50%, probably a bit over 50%, and I was still adding, still buying, and you just got to accept that pretty much. Volatility is the price you pay for performance. All these people that think you can achieve a lot of performance with zero volatility are just, it's just silly. Like you can look back at any sort of high performer, like even take Amazon, like you would have had to have stomached multiple 70% plus drawdowns on your capital. So it's just accepting right from the get-go that volatility is the price you'll pay for if you want outsized returns in this market. And from there, it's judging how much volatility you see coming is how much probably cash you want to hold. And so it's a debate I constantly have with some friends: is what's the right amount of cash? Is it my mentor? He's more towards buy what will be fine in the long term and just ride out the volatility. Since you're your own boss, you don't have investors that are going to freak out on you, so you've got no sort of redemption risk as such from like hedge funds do. And then on the other side, I've got another guy that I really admire, and he's gone to 40% cash, and he's sort of saying, I think there'll be bargains. And so I sort of fall in the middle of that I think 10% for me is fine at the moment. I really want to be able to take advantage if there is some crazy volatility. But at the same time, I really believe in my whole portfolio. And I don't think there's a great chance that some of the prices I've achieved will see again. And so I sort of take that risk by just riding it. If it does go back there, so be it. I still believe in the long-term outcome of them.
So what about uranium? So, that was where I first started following you. And I think you told me last time that it had creeped up to maybe 40% of your portfolio. And that was before a lot of these stocks in December went up, 200-300%. And so where are you at on the uranium market? I mean, it's slowly become one of my places that I have maybe the highest long-term expectations for. And it seems like one of those things that, really might be able to help you escape the matrix and escape the system. And that's really kind of what this channel is about. And so I've been talking more and more about uranium and trying to bring on people that I'm following closely like yourself. So give me an idea.
Yeah, so the short answer is the majority of my portfolio now. When you size something that heavy and it takes off, it consumes your portfolio pretty much. So that's what I like to talk about, like oil services, and I'm literally trying to rebalance my own portfolio in a way, even though I don't want to get out of a single share of uranium. Apart from I did sell Centris, I wasn't comfortable with that in the end with the size that got to in the portfolio and just not understanding the business well enough. So that's largely where I got my cash from. And now it's when, as I say, when someone goes from 40% to now, it's, I don't even know what the proportion of it is now. Probably 2/3 or something. It's really squashed the tankers and the oil. The only one that's really held its own is AR in my natural gas play. It's the only one that's sort of held its proportion in the portfolio. But trying to essentially rebalance into stuff that I think will still do well, and there's no need to chase uranium higher when already weighted it so heavily. So try and go back to where there's real asymmetry in positions that have hated and haven't even had this really first ramp, but can see that they're going to be essential moving forward.
How do you think in an inflationary scenario, barring a deflationary crash or something, but how does this type, because I talk also on this channel to a lot of people invested in precious metals, so therefore we talk about kind of the broader macro play that central banks and governments are doing with the devaluation of currency. And Jay Powell said recently that there's going to be a one-time bump in inflation. And so how does this factor in uranium and in energy? How does it factor into the kind of inflation and devaluation of currency thesis?
Yeah, well, so if you look at history, energy's actually outperformed precious metals by a large margin in an inflationary environment. So if you go back to the 70s, like gold did well. I think you can, if you look at the analysis through from 1970 to 2020, gold put in about 20% per annum over that time, and energy was about 27. So that was quite a large outperformance over that period. And the interesting thing from that is gold was starting off as quite cheap. So you can look back at the price of gold relative to oil. So you can price oil in an ounce of gold. So how many barrels of oil does an ounce of gold buy you? And back in sort of the late 1960s, 1970s, it was about 1 ounce of gold bought about 10 barrels of oil. So that was when gold was quite strong. Now, with what we have now is oil's been just dirt cheap. So last year you had it up around the 40 to 50 barrels of oil per ounce of gold, and it's come down a bit with obviously with oil's rally, but it's still roughly 30 barrels of oil to an ounce of gold. And so historically, knowing that energy already outperforms gold in inflationary scenarios, combined with the fact that gold's actually quite expensive at the moment, I'd expect to see energy absolutely slaughter gold moving forward. I think that, and combined with the ESG movement as well, it's just another tailwind. So I'd expect an even more substantial gap between the performance for the next decade or two.
And how much of that has to do with, and one of the things that's made me even more and more interested in uranium, which obviously is just one sector of energy, but is all these mine closures. I'm someone that's very critical of the government response, but in this instance, I have to say I'm rooting for it. And so how does this type of what happened in 2020 with supply shortages and disruptions, how has that affected the overall thesis in energy, especially when you combine it with an inflationary environment?
It's made it fantastic, to be honest. I use the analogy that it's like blackjack. You're just sitting at a table, and every mine that goes off, you're counting cards, and you're knowing that the probability is going in your favor. So you can keep betting heavier and heavier. And that's the way I feel like we've seen it with uranium. You literally couldn't have a better setup now with just with mine closures like Cigar and MacArthur obviously off, you've got Kazatomprom being affected, and you've got even now with Yellowcake being oversubscribed, so they were only aiming to raise 100 million to get £3.5 million. Now they 140, so now they'll probably be up around 4.5 million. It's just a sucking sound on the spot market, and it's similar across the whole energy complex. We still haven't got over this delusion that we can run the world on renewables. Like it is just, it's interesting because we're starting to see sort of the cracks appear in it with the likes of what's happened around the world. Like Germany obviously had issues with its renewables solar covered in snow and wind not performing at the same time. You've had California, you've had Texas, you had Japan pulled out the last of theirs, and they're building 22 new coal plants. You just see multiple failures, and this is just at the start of the build out. So when we've got these cracks showing, and we're still trying to stick to the narrative that we're going to build out 50%, or some even claim like near 100% of grids on renewables, it adds to this whole tailwind of supply destruction and energy stocks, because people are saying that you're not going to require that energy in the future because we'll be all with EVs and renewables. I'm just saying that's not going to be the case. So I had an interesting question from someone on Twitter the other night. Was saying, like, how does the oil crisis in the 70s compare now with ESG and with just where the oil market currently sits? And I was just thinking it through, and I think it's far more structural now. So similar to the uranium market, where last time around it was more demand driven. There wasn't actually a deficit 5 years out. They had sort of 70 odd million pounds, whereas now we're sort of 60 in a deficit. The same goes for the broader energy market. Is last time it was more sort of a demand shock, whereas now we really have absolutely decimated supply. So supply was quite bad sort of going into 2010 in the oil market, just under investing in CapEx, and then shale patched over. That was just shale's absolute monstrous growth, like added 90% of the additional reserves for the next decade. But now that we've seen shale really run into trouble, roll over, got all the sort of issues I've kind of discussed on the blog and Twitter, like sort of like high grading. They picked all the good stuff. They never made free cash flow. And then you combine that with also ESG and this idea that we'll have these crazy projections for renewables and EVs. Yeah, it's just been massively underinvested. And that, is when you take the sort of supply destruction to that extreme, it's pretty obvious what's going to happen if you've got some patience and can forecast forward a few years.
So if you were building a portfolio from scratch right now, and you were just focusing on energy per your inflationary thesis that you shared for energy, and you didn't have, whatever, Denison at 40 cents or whatever, you still Paladin at 8 cents, what would you be doing, first of all, in a couple ways? Number one, how would you allocate between different forms of energy? If you said uranium is this percent, this is this percent. And after that, what would you be buying? How would you get that going if you knew what you knew, but you didn't have your positions?
Yep. Yeah, so I'd probably, if I was starting from scratch today, I'd probably break it down and probably divide the portfolio into 3 sections, maybe, 25% each, and then start over from like that. That's always like the rough outline I use is break it down into 4 quarters, and then each could be a maximum position size of 5%, so 5 positions per quarter. But you start out at 1% and you decide if you like the company. If it doesn't seem that safe, then just find another company and keep kind of filling that out at 1, 2, 3%ers. And so, if follow through that idea would be I'd still allocate 25% to uranium, and I'd still buy all the stocks back. I'd still buy Paladin today. It just, obviously, it's a very different game buying it at like 40 odd cents, whatever it is today. The asymmetry is lower, but I think it's still there. Whereas, the 25% in oil services and offshore, that would probably, I think that's going to be the sort of uranium type returns in another year or so. And so that would be 25%. I'd go through and pick up a lot of the stuff I've been buying now, to be honest. I've been buying like the likes of Tidewater, Saipem, which I talked about in the blog. Like these ones that are still quite safe in the fact that everyone hates them. I love using what's it called, Baker Technology as an example. It's this little Singaporean offshore service stock, and for a while there, it had more cash on its balance sheet than market cap.
Wow!
Yeah. You got to say that that's just absurd. And so all these are just like creeping along the bottom, and they've started popping up. And so fill another quarter of the portfolio with that. Another quarter would be tankers, like just offshore tankers. I like that long-term trend that they're essentially running into the ESG trend as well, because there's something called IMO 30, in which they will require that all tankers have reduced their emissions by, it was 30% by 40% actually by 2030, and further 70% by 2050. And so that's made it almost impossible to order new tankers because no tankers exist that meet that requirement currently.
Wow.
And so the order book's just absolutely been decimated. So it's like a 23-year record low. So that's kind of another situation when at some stage, the current tankers will roll off. They've only got a lifespan of around 20 years. They've got quite expensive surveys, which makes it increasingly uneconomic to keep them running. So they start rolling off, and then you have this point at which you're going to have more, or the price will go up. And so, the price will solve that problem, just like it will in uranium. And then the last quarter of the portfolio would just be sort of a collection of a lot of things I think I've talked about on Twitter, like the likes of tin. I've been increasing my allocation to tin. I've got some stocks like copper and nickel, some other just anything I like, even some precious metals. I do like some of the silver plays, and just fill the remainder of the allocation out with anything I see offering value in that space. So that would be how I would restart from today if I just had my entire account liquidated into cash and had to go again.
Interesting. So what's your long-term goals or your time horizon? Is it you play an inflationary energy trade and then you just and you keep doing your same strategy that you always say, which is you find what you hate next?
Yeah, so I've nearly finished the blog. It should be out by the time you post this on coal, and that is the idea that rebalancing out of something that's done super well into another thesis that you've got that you think has like a different form of asymmetry can be the best way to exit. So it all depends on what the relative valuations are at the time, which is kind of the reason I like the coal thesis, is we can just watch it play out. But the basic idea is that with uranium, it's going to be extremely boom bust. I believe ESG money is going to chase it. So I think it could be quite violent, whereas a sector like coal just is cut off from institutions, cut off from pensions, hedge funds. Everyone can't touch it. That's got an ESG mandate. And so in that way, you might not see it rally, still rally a little bit, but it won't get any of the love that the rest of the sectors get. And you can rebalance into it and have something similar to like the tobacco stocks in the 80s, in which, because no one wanted to touch them, you got large like free cash flow that no one would touch for another decade or two. And so that's something that I've just finished writing about, and I think that could be quite an interesting play.
If you didn't have any money invested in uranium, would you be buying at these prices right now, or would you be waiting for a pullback given they went up 200-300%, right? And I ask you that because there's a lot of people that follow this channel that have been introduced to it, over the last few months. People that got little positions and they've done real well. And then other people that maybe they haven't yet, and they've just watched them go up and up and up. And they're saying, do I buy now or wait? What would you be doing if you were investing in uranium from scratch right now?
So I get asked this question a lot as well. I just say if I had an allocation, say I'd probably dribble half the money in on any sort of volatility I could see, any lows, and keep the other half ready for a more substantial smackdown. Because the risk you run, like I kind of said at the start with uranium, is that it really runs hard and the pullbacks aren't even to where you are now. So that is a risk, and that's what everyone that loves to, it's kind of like if you go back over the broad indices, and no one ever talks about the risk of going to cash in the market just getting away on you, and you can never bring yourself to buy back in higher. So that's got its own sort of opportunity cost as you will. So in the smart way is just, I don't know, say you're 10 grand, you'd take 5 grand and you just dribble it into your favorite stocks, gradually just buying, and then the more bearish you are in the market would be the slower you would allocate. So you might only allocate sort of 5% a month, or if and hope that you have the remainder to put to work on a bigger pullback. Whereas, I don't think it's smart just to sit entirely in cash and wait for this massive pullback. That we're talking such a tiny liquid sector. And with everything else stopping working with this and the reflation trade, it might not actually might not live up to what everyone's thinking of a pullback. Just looking at some stocks, I've been trying to get more exposure to global atomic, and the thing never trades down. It even has, every time it has even a slight slip, the next day it's up even more. And so you've got stocks like that in the space that even with a recent sell-off in the market, it simply isn't. It's held by strong hands. It's held by people that essentially believe in the long-term thesis, and they're not going to be shaken out easily.
I did notice that a lot of the, I guess you'd call them penny stocks in uranium, while a lot of things have been selling off. Like there was a while, I think this morning in the previous trading day, where Energy Fuels was down like, I don't know, at one point intraday, like probably over 10%. And I looked over and Bannerman was up 2%, and some of these very small penny stocks were up. And I thought what you said, I said, wow, there's not a lot of people that are going to get scared out of these positions, huh?
Yeah, exactly. So some of that's the difference in trading time. Like you can, like Bannerman's only traded in Aussie, so you can look at it when obviously Energy Fuels is trading in the middle of, it got sold off hard, I think, last night, and it bounces all over the place.
What are you buying in uranium right now?
Not much, to be honest. It's already the vast majority of my portfolio. I'm buying offshore oil is where all my money's going. I had just tried to increase my weighting to global atomic, was the last one that I was trying to size it up to get more. It got quite uneven with because I sized Paladin and Boss a lot heavier, so those are really run. So I was trying to get a bit more exposure, but it's not coming down at all. It's not coming to any levels that where all my buy orders are. So if anything, I just keep getting pings, and I'm buying more sort of offshore oil stuff like like talk about like Tidewater, like Saipem, like Baker, MMA offshore, just all these ones that you just see that are just creeping along the bottom. They look exactly like sort of Paladin and Boss did before they took off. These sort of super cyclical stocks that have yet to have their heyday, but I think it's coming if you've got some patience.
So I was talking the other day to Brandon from Bannerman, and he was talking a lot about China. And as if I feel like I probably couldn't get more excited about the uranium thesis. These stocks are pretty high. I mean, not pretty high, but they've run quite a bit. But long term, I mean, it's insane. He said that by 2040, he said that China's demand for all the uranium that they need will exceed the present global mined annual supply, I think was the years that he gave me. And I thought, wow, that's really a black swan. Do you think that's the biggest black swan is China, or do you think there's any other bigger black swans to the uranium market?
Yeah, no, China certainly is. Brandon's brilliant. It's as in black swan of what could possibly tip the thesis over.
Yeah. Or is it hedge funds? What is it? What would you put your money on?
What could tip it over would be a nuclear accident, would be the only thing that would really set it back. Like ultimately, we don't even need the growth now. Like the story is already pretty much written in stone with how undersupplied the market is, with how much demand is currently required. So everything that's just been added, like I see China just released its latest five-year plan, and they're adding another 20. They're going to add another 20 reactors, or propose another 20 reactors by 2025. This is huge. Like, people just don't understand how much they're just and how quickly they can build it. And it's not like America where you like kind of talk about building a highway and it might happen in like a decade or something like this. Like, I don't know if you've ever watched those YouTube clips where they build like a new train station overnight. Like, they're just amazing. For black swans, and it's really just a nuclear accident at this point. I don't really see anything else that can derail. And it's interesting how much like the mainstream media is just coming around. Like, I tweeted yesterday, woke up and subscribed to The Economist, and the first thing they sent me in the morning was don't I forget what the title was. It was like, nuclear is required moving forward or something. We can't touch nuclear. I was like, I use them more as a quantary sign. Usually they've got silly headlines, but for them to be spotting really does show that the tide's turning. And I think if anything, it's more the right tail risk, as I talk of it, nuclear getting a far more broad acceptance. Like, you've got France that was supposedly supposed to be going fully building out renewables and shutting and retiring. Can't remember the number of reactors now, but they've just given them all 50 years extensions, which is another, I think it was 120 million pounds over their 50-year life, which is another 2.5 million pounds a year required. It's just all these things keep stacking up, when at the same time everything on the production side keeps getting worse. Just to come back to that blackjack analogy, you just keep counting more cards and it just keeps becoming more obvious. And so that's why uranium really is a rarity in that demand. It's just, if anyone ever opines on the future potential of like gold or copper or something, you can have projections, but that's like, especially gold, you're just trying to guess at what people's desire to own gold is in the future, which is a pretty abstract thing. With uranium, you're talking about price insensitive fuel buyers that lose their jobs if they don't buy uranium to keep their reactor on. It's a very, very different scenario, and they will get fired if they don't source a few $100 million worth of uranium to fuel their multi-billion-dollar reactor. It's John Bostock had this fantastic analogy the other day. He said it's like a group of people all driving to the airport to take a flight, like an international flight, and they've all got they're all on the yellow light in their car, and they'll pull over, and they've got to buy gas, that last bit of gas to get to the airport, and they will turn up and there's only a certain amount of gas left. Do you think they're going to make economic decisions to buy that gas? Do you think they're going to only be prepared to pay the standard sort of petrol price at the time? We said no. Like, you're thinking about like the cost of the flight, the cost of everything involved in that. For that that extra 2 liters of fuel, you'll happily pay whatever price is offered just so that you can secure it. And that's where like security of supply is absolutely critical with the fuel buyers and with the uranium industry. And there's no other sector that kind of has that to that extent.
Yeah, to be honest, I don't consider myself like the brightest mathematical type of person or anything like that. And what really attracted me to uranium was how simple and easy it was to really understand the entirety of the thesis. I'm like, okay, so if you use 200 million pounds, but you only have 120 million, how much left is that, And I was like, wow, this is pretty interesting. And so I have to think that personally, that a lot of people with big pockets have to be doing simple math. 200 million minus 120 million equals 80 million. And so my question out of that is, what would you give the likelihood, 10 being an absolute and 0 being an improbability or an impossibility? What do you give the likelihood that in 2021, we see a significant move in spot from hedge funds or institutions front running the available supply?
So I think it's high. So all you need to do is see spot start moving for it to pop on the hedge funds radar. So they don't want to go first. They don't want to be the person that buys it and they're stuck holding it for another year or two. You've got to remember, like, hedge funds are essentially momentum traders. Essentially, it's de-risked once it starts to move, and then they can create their own reality. And that's kind of what happened last time around, I believe. I don't believe they started it. They just piled on when it got going. And so they, as you say, it's doesn't take much intelligence to understand that there's already a lot of strain on the spot, and they can severely increase the strain. It's kind of like what happened with GameStop in a way. Like if you see someone caught, like literally Melbourne Capital couldn't exit because when you push the short float past 100%, you kind of get trapped in, and then everyone just piled on. And so I think you'll see something similar happen once, they understand how thin the spot market is. Once it starts moving, then these guys aren't silly. They'll understand that they can really squeeze this market. But you'll need to see the sort of the fuel buyers show their hand probably first. That's if the sort of the Xataprom and Chemico and now Yellowcake all buying on spot doesn't move it first. So I think it's highly probable we'll see it this year. I even I just watched a few days ago John Borstoff, who's he was the original, he founded Paladin, and now he's with Deep Yellow, another sort of uranium mine, and he's always been quite sort of non-committal on sort of forecasts and said, it probably doesn't kick off out till 2023. And now he was saying, he sees, this is the first time he sort of made a forecast. He said there's no way he doesn't see it at sort of $60 plus by next year. And so for him, who was always kind of pouring cold water on the whole thesis, to come forward and say, it's going to be up there, is really, really good, because he's obviously understands the whole cycle better than anyone. So this whole thing of whether it happens in the coming months or happens next year, I don't really care. All I know is that we've already got this sort of price appreciation before any of the care and maintenance mines have restarted. So once they all restart and people actually have cash flows to analyse, and it's also essentially front running the institutions. You got to remember, a lot of the institutions can't invest in these smaller guys when they haven't got liquidity. They need sort of a minimum of a few $1 million a day of liquidity before they can get involved. They need it to be a certain size market cap so that they don't have too big of positions in it. So they have to sort of announce their ownership. So once they start to grow, then you get this sort of reflexive cycle where institutions start getting involved, and that's what happened last time round, and that is obviously really boosts the returns as well. And obviously more people will pile in once one hedge fund has the trade on. Then hedge funds are like sheep; they all like to chase the trade and help squeeze it.
Interesting. So What would you say are the most important philosophies for your life? I think there's a lot of people listening to this that they either want to create more freedom for themselves, and that's why they're interested in this channel, or they're concerned about what's happening with governments all over the world. So they want to create their freedoms. They've seen people losing their jobs, so they want to create their freedoms, whatever the motive behind it is. And you're someone that, you're a interesting guy. You're living in a beautiful home and you're in Bali in a beautiful country, and you make your own schedule, make your own life, and you've built your own career in the financial industry. What do you think are some of the most important philosophies that have really aided you, or you think would be valuable to a viewer?
Well, the first most obvious one is just to spend less than you earn, be building some sort of wealth, like some sort of ability to have fuck you money, so that you can actually what I always said is a lot of people don't actually value freedom so much as just freedom for the wealth aspect. It's more freedom from having to answer to bosses and bullshit and daily meetings and being told all the sort of HR crap that goes on in corporates these days. Like, it was just soul draining no matter what the salary was when I was in corporate world. I can only imagine what it's like now with how much stricter everything's got, and how anything can be an offence in the office. So mine was just always be saving, because you can't get anywhere if you're living above your means. I saw that a lot in Australia, called them the 30 grand millionaires, where they were like analysts at banks, and they would literally they would have like a new BMW where it would all be on lease. They would have the fanciest apartment, which they would literally just be able to afford out of their rent. And then they're going out and spending. They wear nice suits, and it would all be going on the credit card, which would just get covered the next month or actually be behind. So they'd start carrying credit card debt. And you're just never going to get anywhere that way. So unless you're putting something away. And the other thing is not to be, I always think the whole sort of, don't push your spending below like a certain limit. That you just got to work out how to earn more. And so that was.
Say that again, because that's a really interesting one.
This whole saving on coffees and crap like that, it's just silly. Like there is a bottom line at which you're not actually doing yourself any favors by trying to squeeze your budget a little bit more, especially if it's stuff you enjoy. It's more concentrate on the income side. Like, how can you actually earn more? Is there something that you can start charging for? Like, we're in the world of e-commerce. My girlfriend, she's started a fashion business in only 3 months now. She's doing super well out of it, and she never had anything to do with it before. So there's all these little opportunities everywhere around us, and you've just got to start them and start small. It's always a side business while you're still collecting your main income and building up reserves. Like I hated corporate world, and I was there for all my 20s until I could save sort of low six figures and could say see you later to my job before my 30th birthday. So a lot of it is you have to do what you dislike, but it makes it a lot easier to stomach if you've got an exit plan, if you can see the light at the end of the tunnel, and to try and save what will be that side income. Like, I don't know, there's a million ways to make a side income these days, but just do something that you can stay consistent at. It's kind of like a lot of these courses are like, people buy it and it's like buying a course from like a bodybuilder at a gym where it's absolutely of no use to you. All you need to know is to be consistent with, even if it's just like a few push-ups in the morning, but if you can do that day in, day out, then you'll start to get results, and that'll keep you consistent. So it's the little thing that you can consistently stay at. And even if the first year you only earn sort of $100 passive income, the next, not passive, even earning it on the side, that you can build it out and replace your income without having to sort of be on a salary. Because it's the interesting thing I've learned is the fact that you actually make an awful lot more money when you're lazy and you have more time on your hands. Like I've made more money than all my corporate world combined by when everyone's called me the laziest. Like they're like, what do you do all day? All I see you is reading, or like you're either like surfing, or I do Brazilian jiu-jitsu now, and thinking of like the 12-hour days I worked in corporate world. But when you sort of give yourself that mental capacity to spot more opportunities, to get involved in more things, then it all snowballs quite quickly when you can get your head above the water of just corporate bullshit.
Is there any way that that's changed, or is there any new additions to that now that you aren't 20 something years old trying to put away a little bit of money, now that, you're a successful investor and you've done very well in the markets? Does it shift once you have money, or is it the same type of principles?
I guess it's the same principles overall. The thing is, with what I've done is actually quite hard, because it's, I wouldn't recommend what I've done, because I know just whenever I mention it, like having a decent six-figure salary is quite hard for a lot of people in the first place. So that's not that realistic. What's more realistic is just getting a small side consulting job, e-commerce thing that can just replace your basic cost of living. Mm-hmm. And that's, if I was to start completely again, that would probably be where I would start, and build an audience of some description. Like, I've only sort of worked out this whole Twitter game just over the last year, but and I obviously was never doing it. I was doing it more for the community side than ever thinking about money. But now that you do see it grow, kind of do understand the way that you do have an audience that is always there potentially to monetize, which is kind of interesting in itself. And so I think everyone should be building their own audience, that if they ever have something that they can direct people to, it just makes so much sense to me. And also just always nudging away at some side income that they enjoy and that they can slowly scale. Like, nothing ever happens quickly. That's the biggest lie that everyone always tells you, is that you can quickly do something in the markets, or like even now we talk about like Paladin and stuff, like everything. Like I always like to say, asymmetry is backloaded. Like, you look like a genius quickly, whereas you were going sideways for 2-3 years with not much results. Yeah, and then everyone likes to concentrate on that 3 to 6 months where all the magic happened. Well, yeah, I was living cheap and cruising around for 3 years before this all kicked off. So it's just to be constantly building towards something that's going to give you that freedom and give you more mental bandwidth to find these opportunities and do even more. That kind of snowballs on itself and gives you more freedom. And also I was going to say, the last thing is get out of developed countries and large. That's my last sort of point. I can live like a king here in Bali for 2-3 grand a month, whereas that was like staying at home and eating noodles in Australia, kind of in Melbourne and Sydney and stuff. So, yeah, so it does. It really does make a difference if you can live somewhere, because then you're saving the difference, which is put my reinvestments through the roof. Like, it always pains me if I have to if I had to sell, like going back a year, have to sell some of my most loved positions to for rent or something like that. And so if you cut down that sort of the living cost, you can ramp it up eventually. But ultimately what I've found is I don't really need to. We've got a beautiful house. I love going surfing. I love going to the beach. I love doing jiu-jitsu. Don't need a new motorbike. You don't need a lot more out of life. About the only thing that I do like to spend money on is fancy trips every now and then. And that's about it.
Absolutely. That's I think, a fantastic way to end, and something we've been talking a lot about on the channel. And what I've been saying since I started it was the importance to have an additional source of income, and hopefully something that has the potential to scale long term as well. And as I've seen what's happened to people's livelihoods from governments this year, you realize, you need to diversify your sources of income. And so I think that's a fantastic way to end. For everyone listening, right there down below, we'll have Ferg's Twitter account right there down below. He's got a great blog that he writes on as well. I highly recommend going down, clicking the link, give him a follow right there down below. If you want to see him back on, if I missed any important questions, give us a comment down below. Let us know some of those questions that you'd love to see answered. And make sure you hit the like button right over there on this side, right over there on this side. Send this out to more people. Let us know your biggest takeaway from the video. And thanks for coming on, Ferg.
Thanks, Jake. Enjoyed it.
Awesome.